So today, we are going to look at a case study where an individual is moving a total of $1 million into a whole life insurance policy. But what we will look at specifically are two things. First, why is he interested in a whole life insurance policy? Specifically, moving a total of $1 million into a policy, and you'll see it's over a short period of time as well. So number one, why he's interested in a policy. And then number two, the process we took him through in order to help him refine his decision-making process. Meaning, how can he be sure that he picks the right policy that is, number one, maximized for cash value upfront, long-term, also maximizing the long-term death benefit. But then number two, the policy fits his needs regarding funding flexibility, regarding how he can use the policy with respect to loans, why he's interested in the policy, and then the process we took him through to really decide on the right policy for him. So to provide some details, here's what he wants to do. He wants to take out a whole life insurance policy, and he wants to use the cash value for his business, and then he mentioned possibly for real estate. He is also interested in the death benefit. He wants to set it up where the beneficiary is his trust, and then the trust will specify how those death benefit proceeds are paid to his family members. But those are his two main goals. So a little bit of details on the individual himself. He is 39 years old. How he wants to fund the $1 million is as follows. He wants to fund $200,000 per year for the next 5 years. So when someone mentions this, I've got a couple questions for them. I also have a few items that I want to make them aware of in order to make sure that they understand how they can really maximize the value. What I don't want to do is just say, okay, here's what we want to do, and then brush over something that a lot of times people are interested in and I never showed it to them. So then later they come back and say, hey, how come you never showed me this? This is a big source of buyer's remorse when it comes to whole life insurance policies, specifically lacking awareness. So number one, company and product choice. When it comes to company selection and whole life insurance policies, we're big believers of the four major mutual companies, being Mass Mutual, Guardian, New York Life, and Northwestern Mutual. The simple reason is that we've seen them deliver strong actual results when tracking the cash value and death benefit performance over time, not just good illustrations. We'll go through the different products we showed him. Funding flexibility is huge. We're going to go through the details on this in a minute. And then with respect to policy loans, he mentioned that he wants to be able to use the cash value for his business and possible real estate. So having access to his cash value is very important. So generally, whenever one is taking a loan against a life insurance policy, the average turnaround time is 3 to 5 days, 3 to 5 business days to be specific. Loan interest rates can typically be found somewhere between 5 and 6%. Often you can find fixed rates at 5 and 6%. Sometimes they are variable. That 5% variable rate, which is what we're seeing right now, that's as of April 2023. It's variable, so it will change over time. But let's hit on this because this is the big one, especially when you look at larger dollar amounts, him wanting to be able to pay $200,000 per year for the next 5 years. So a question I would have for him is he comfortable and does he want to fund the $200,000 every year at the start of each year, start of each policy year? A policy year is if he started a policy in April of 2023, then April of each year is when the next payment is due. So if he's comfortable writing a check, sending the funds to the insurance company of April each year, is that what he'd like to do? Or would he like more flexibility? Because that is a very important question, A, when we're looking at large dollar amounts, any dollar amount really, but then B, it will really help one decide the company that fits them best. So when we look at funding flexibility, if I'm funding a policy with $200,000 per year, I can set up a policy with both Mass Mutual and Guardian like this. I can allocate 10% of that $200,000 toward the base premium, and then 90% of that toward the PUA rider. PUA stands for paid up additions. This is really what maximizes the cash value. Short term, when I look at the guaranteed values, I'll have more money short term and long term. But this guy is the key to accelerating the cash value growth in a life insurance policy. So, to briefly summarize, when I look at MassMutual and Guardian, those are two of my four major mutual companies that offer a lot of funding flexibility. Here's the big difference. If he's comfortable sending a payment in one time per year at the beginning of each year, let's say it's April, assuming he starts in April, MassMutual will work beautifully. If he wants some flexibility, where he says, okay, I'm comfortable sending a payment in at the beginning of each year on my premium due date, but what if I can't fund the full $200,000? What if some of my capital is tied up? Well, with MassMutual, he can adjust his payments one time per year. So let's assume years 1 through 2, he pays $200,000 in. Year 3, things are a bit slower, and he only pays $100,000 in. If he wants to increase his funding again, can he do it during year 3? With MassMutual, in most cases, he will not be able to. I should rephrase. He can, but he will not be able to unless he goes through medical underwriting, has to fill out paperwork. It's kind of a pain. It's not convenient. When he could scale his payment up again, on the 4th year, and he could go back up to $200K, he could even make up for lost time and pay $300,000 into the policy that year. Main item to be aware of, one time per year, I have to send both my base premium and PUA payment in at the same time. If we design a policy to be flexible with MassMutual, just knowing that I can easily adjust it up and down without underwriting one time per year. Guardian, on the other hand, what he can do, he can commit to that minimum premium of $20,000. That can be paid yearly. He could also break that up over 12 months. So he can commit to the minimum only. This is what he's billed for. And then 100% at his leisure, he can add the remaining funds into PUAs, the other 180, but he doesn't have to either. How he adds those funds is by logging into his online portal, mailing in a check, can send in a wire payment, whatever it might be. It's extremely flexible. So, depending on his circumstances, if he already has the money in cash, MassMutual will work great. And you can do the same with Guardian. You could send it all in at once if someone prefers Guardian. But if he's got the funds in cash, we know MassMutual will work well. If he says, I think I'll have the funds every year because I have over the past several years, the cash always comes in at this time of year, but I'm not sure if it will. Things could go south. Guardian does offer that flexibility where he can commit to a minimal amount and then add more funds at leisure. So let's look at a quick sample here. What we've got are 3 different examples, one with MassMutual and 2 with Guardian. With MassMutual, we've got a 10-pay policy. What 10-pay represents is the fact that he can pay into it for a maximum of 10 years. He does not have to pay into it for 10 years because you see we stop altogether here. First year's the worst year, pays in $200,000, has a little bit less than 180, that's about a 10% hit. As we look at it each year, by year 4, I've paid in $800,000 total, and I have $800,000, a little bit more. That's in cash value. The death benefit's also growing, and it continues to appreciate over time. You will see the death benefit drop here after the first 7 years. This is optional, but what this is a method that we often exercise to reduce the insurance expenses so our cash value can grow at a faster pace when we're not making any more payments. But here's our MassMutual 10-pay product based on the present dividend interest rate. MassMutual for 2023 is 6%. Always remember that the dividend rate is a gross rate. We'll never see a net earnings rate of whatever that dividend rate is. And then we've got Guardian, the same product, this L95 policy, which means you can literally pay the premium up until age 95. Not many people do that, but that's how long we can pay into it if we want. But we see this 10% PUA fee and 5% PUA fee. In short, the 10% PUA fee offers greater cash value and death benefit performance long-term, whereas the lower PUA fee, 5%, offers greater cash value upfront, but we'll also see greater cash value short-term and long-term when examining the guaranteed values. So if he says, hey, I'm very, very conservative, I want to see the guaranteed values, this guy will jump out as displaying the strongest overall guaranteed cash value short-term and long-term, which is something definitely to consider. A lot of people like the stronger guarantees as they compare and contrast the different options. But this we send with the full illustrations from the life insurance carrier, but this displays the three different options side by side. Here I see a bit more cash value up front, breaking even between years 3 and 4. If I want access to capital earlier on for my business and real estate, and I want that flexibility, fantastic option here. When I compare it to the 10% PUA fee, if I really like that flexibility, if I said, hey, the difference here of by year 4, what is it, about $30,000 comparing the two? Okay, little bit less than that. I break even year 5 instead of year 4. If I'm okay with the cash value difference really in the first 10 years, meaning having less over here compared to what I see at the 5% PUA fee, and I don't think I'm going to need to access all of it, then I may gravitate toward the 10% PUA fee. At least that's what we see people do. And if I'm comfortable with a one-time per year payment, this 10-pay product really provides strong cash value up front and long-term when we look at it. It's a nice option there, but a little bit less flexibility. And then what we'll show in a case like this are some additional reports. If someone wants to see, hey, what is my money growing by each year? Here's the yearly cash value growth, and then here's the total gain on cash value. The yearly cash value growth, by the way, displays what you are receiving from the insurance company, meaning we do not want to include your payments. For example, if you look at year 5, in year 4, what was your cash value? Looking at the MassMutual example, 803, you paid in 200, now it's worth $1,035,000. So you got your $200,000 back, which would bring you to $1,003,000, but then we see earnings of another $31,675. That's what we received from the insurance company in this particular year, again, based on their present dividend rate and illustration. But that's how we measure the yearly cash value growth, and the total gain just looks at how much we've paid in compared to our total cash value, and the difference is the gain. We did that for each of them. For individuals that prefer percentages, we'll look at the internal rates of return, but same options here. And if we narrow things down, we may delete one of the options. And then with the loan scenarios, what we did here was plug in the MassMutual 10-pay product. We've got the internal rate of return, then the yearly cash value growth, and also the total gain on cash value, and then how much you can loan here. So this is a workbook that individuals we work with can use. We send this to everyone we're working with. Let's assume in year 4, he loans $700,000. There's the $700,000 loan. Here's a 5% variable loan interest rate. This is variable, so we would want to change it over time. There's our cost to borrow. But really what we like to look at here, let me model some payments beginning year 6, so we'll pay interest only for 1 year. And let's assume we pay it back at 100 per year. We can pay it back however we want. This just makes it simple. Here's often what individuals like to look at. Over here on the right, we've got your yearly cash value growth compared to your annual interest payment. So the first year that I take a loan out, $700,000, I pay $35,000 in loan interest to the insurance company, and I see that I received $20,000 in change. The following year, year 5, what's your gain here, or the yearly cash value growth? 31 and change, you paid $35,000 in loan interest. We're upside down, meaning we're paying more in loan interest than what we are receiving. It's important to be aware of this, and then people will either A, say, okay, I'm aware of it. I'm okay with seeing 2 years where I'm a little bit behind. Or some will say, I'm going to take out a lesser loan to ensure that that does not happen. But as long as I can see the numbers and I've got control over the situation, then I can make sure I'm not in a situation where I'm uncomfortable if I'm in the red too long. We see here by year 6, once we start to make payments, we're paying down the loan now, which we're paying the loan interest, and $100,000 toward the principal each year, but we're no longer funding the policy. So $200K in cash flow is freed up. But now, as we chip away at it, we see that our yearly gains easily exceed the interest we're paying. And then we do the same thing with a total gain on cash value. compared to the total payments. People want to see, what are my earnings compared to what I paid? And then I've got the death benefit that is paid 100% income tax free as well. It's not exempt from estate taxes. It's always paid income tax free. If I want, for estate planning, typically we'll have it owned by a trust and such. There's different types of trusts. We usually involve an attorney, whether it's your own or someone else, but that's another conversation. One other thing, just to mention very, very briefly, an actual loan illustration, you'll see this. If you have a $700,000 loan out and you were to pass with that loan outstanding, the death benefit would be what we see there minus $700,000. So $3.2 million and change would be paid income tax free to our beneficiaries. So I hope you enjoyed this video. Let us know if it helps and if you have any questions at all, and we will see you in the next video. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.